All right, so we're going to get
People don't know what they're
started.
missing.
What's that?
People don't know what they're missing.
Yes, exactly. We want you to get all of this content. You can't miss anything.
Or they do.
Yes. In that case, we're going to put Doug first. So thank you all for joining the panel. The panel name, as you saw up front, is the Transformative Acquisition, but we're going to put more context around what all of that means. And the panel after us is about company valuations, so Denzel will do our best not to steal your thunder. So I took all my valuation slides down and left them at home, and you're good. I'm Scott Peters. I'm the co-president of the Jordan Edmiston Group. Been working there since 1997 with Wilma, who's sitting over here. Was with a company called Verona Suler before that for about 4 years with Andy Buckholz back there. So it's a very small world that we all live in. We, just as a side note, are an independent investment bank, been around 27 years doing mergers and acquisition advisory around all of these markets. So we've had the benefit of being able to watch the evolution of media sort of from the front lines as people think about how to value businesses, how to restructure, how to transform. And so we've been sitting in an interesting spot. So when this panel came up, I thought it'd be a fun topic for discussion. The one thing I'll say before we get going is we'd love for this to be an interactive dialogue to the extent anyone feels like interacting. So we will go through sort of a good amount of content, but feel free to interrupt, ask questions, and make it more fun, because usually it turns out to be a better session that way. So first, we're going to do some introductions. I'm joined today by 3 people that I've known for a long time and have done work with over the years, and coming all from different angles, I think, within the industry. So first, Dan Oswald, who's the CEO of BLR. I'm going to let him introduce himself in a minute. And Dan Kortick, who is a partner with the Wix Group. It's a private equity firm in and around these markets. And Doug Manoni, who is CEO of SourceMedia. So why don't we start with quick introductions, and then we'll get into the discussion. So Dan, do you want to go first?
Sure. I'm Dan Oswald, CEO of BLR. We're a information business primarily serving 2 markets, HR and EHS. We recently, last year, made an acquisition of HC Pro, which took us into the healthcare business. All of our information is based around compliance, so compliance information company serving those 3 markets.
As Scott said, I'm Dan Kortick. I'm a managing partner at the Wix Group. We are a private equity group based in New York, investing solely in information, education, and media companies. Those industry segments tend to intersect quite a bit. Our firm's been around for 25 years with the same strategy. Obviously, these segments have evolved over that quarter century, but we've been involved with them since the start. So hopefully, we have some perspective.
Doug Manoni, CEO of SourceMedia. SourceMedia is a digital information marketing services company. We serve the financial, healthcare, technology sectors. And the business serves about slightly over 2 million C-suite executives, highly engaged. Our flagship publications include American Banker, The Bond Buyer, and Financial Planning, among many others.
Terrific. And Doug has an impeccable fashion sense, as you're going to notice as well. So I guess I'll set the frame here. So there is an internal and an external dynamic, I think, as you think about mergers and acquisitions and how they're used for strategy. The internal dynamic is you've got companies who are all going through sort of a massive amount of internal change. And through, think about traditional, print B2B media evolving all the way to, at the other end of the spectrum, SaaS workflow solution models that are, driving entirely new sort of value propositions in the market and valuations. So the internal operational issues we'll talk about in a minute, but that's having to deal with, what are your customers' needs? How are they evolving? How is your competitive dynamic evolving? Do you have the right culture to make that evolution, possible? And then on the external side, valuation being one of the core drivers. On the one side, if you're ever going to sell, what's going to be the most valuable sort of business model to present to the market? As you're thinking about where you invest, what areas are you going to invest in your company to drive the highest return, in general? And so there's sort of those internal and external dynamics coexist, but depending on where we are in market cycles, there's a lot of sort of debate and discussion that goes around how you prioritize or strategize on both fronts. Going back, so what we've seen over the last 15 or 20 years in valuations, an evolution as technology sort of come into the mix, and a technology and data framework which has taken traditional multiples which have been valued, let's say, for a B2B magazine on EBITDA historically, so the earnings of the business. On the one side, 6 or 7 times for magazine business, which today has shifted up to the data and analytics business models and to SaaS models into the multiples of revenue. So what might be a 6 times EBITDA multiple for a magazine could be a 6 times revenue multiple for some of the other business models. And that's caused a lot of dislocation in the market and opportunity. But as we go through this discussion, we're going to start with the internal dynamics. I'm going to start with Doug Manoni and talk a little bit about the shift. If you've seen your business sort of go from more traditional B2B media to where you are right now and where you're going, and some of the challenges that you've been faced in dealing with that. And then part 2, after, we'll get into some of the M&A dynamics.
Happy to do that. So, and I think that a lot of the things that we're talking about today, and this panel will talk about, probably is consistent with some of the things you heard with the keynote speaking as well. And I think what I would start by saying is one of the points that you made in your introduction, Scott, and that is everything that we've done, we've really done in response to a market need, right? It was a market need, but also what we're doing is we're searching for a better business model, because just like Brent was saying, this morning, in 2009, SourceMedia found itself in a very difficult position. We were heavily reliant upon print advertising. That changed dramatically within a 24-month period. And so we had to search for a better business model. And what we're looking for is we're looking for revenue diversity, number one. And we're also looking for recurring revenue streams that we didn't have in the business. So we thought the path to that was twofold. Number one, we had to find ways to drive engagement, because driving engagement would allow us a better monetization model. And we had to expand the products and services that we're providing to our marketing services clients. So we found that the path to that growth was through various investments in our business. And one of the first things that we did, when I first took the helm, the business had limited investment, but we were able to unlock some investment dollars. And the first thing we did was we unified all of our customer databases, and that gave us a much better view of who our customer was. And then we also, without getting into a lot of details, we made a lot of other internal investments that enabled new revenue streams and new capabilities within the business. And we outsourced a lot more services. We went to marketing automation companies and such. And all of that cleared a way to a very new and a very different business model, and brought us along in our transformation. But I think one of the more unique, organically developed business models within SourceMedia is that we launched a research business. And the research business initially was focused around catering to marketing research needs of our marketing clients. And the whole idea was that we could assist them in understanding what they wanted to know about a market, whether it was through custom research, whether it was through syndicated research. And one of the more interesting things that we've done is we've created indexes in various markets on various subjects. Very, very successful, great response. It's a business that's grown very rapidly within SourceMedia, and it operates at a very high margin. One of the other things that we learned, though, is when we're interacting with our marketing clients, at the early stages of what their marketing strategy is and what they want to get out of a research project, we have a firsthand view of what their objectives are. And it puts us in a very unique competitive situation, because we understand what the objectives are, and we have the ability to then follow on with, by adding and providing branding services, by providing with thought leadership solutions, and also with lead generation. So the research business for us has been very successful in helping to transform the business, although it's only one component of it. But as we move the business model forward, and we've been in this business now for we're going on our 3rd year, and the broader vision was to expand it beyond, research or market research for our marketing clients. What we really always had a vision for was the ability to introduce paid subscription-driven research reports. And literally in the last 6 months, we've leveraged all of the research capabilities that we've developed in-house, and we've launched paid subscription-driven research. And it got off very well. Again, one of the things that we did, and we will continue to do, and I would suggest that everyone does here, when you're managing a B2B information company, your core assets are your brands, your audience, and your content. And that's exactly what we're doing. We're leveraging those core characteristics of our business and the development of the research business, and now in paid subscription-driven research. And our aspiration is that as we accumulate this market research on our business, and we accumulate the recurrence of this data, we will put it into a repository, and we believe we're building a real data product that will have increasing value over time as we build out this business. So the sum total of these initiatives is that we've really transformed the business between the digital development of the business, and that we've been able to build through the investments by introducing customized marketing solutions, and with a lot of marketing automation capabilities, performance marketing capabilities. And today, our business is over 50%, or over half of the business is digital. Just over a third of the business is print, and the balance of the business is comprised of this research business and conferences that we produce. So it's a radically transformed business from what it was in 2009. And also our profitability is significantly higher as well. So,
and I guess I would add to that, just for context. So, Doug, at Source, you had a private equity partner that had owned the business for a long time before you had gotten there, had divested a big division of that business, and was not really acquisitive during sort of the Manoni chapter, for lack of a better term.
I like that.
So, in fairness, you were forced to transform, on organically and with the team around you, which is a little bit of a different dynamic than a company that can go out and buy and just try to accelerate that transition. But we'll circle back to that in a second. So I'm going to switch it over to Dan Oswald, and maybe Dan, before you jump into a similar question, if you could give a little bit of color in your sort of background, because you've really come up through a lot of interesting transactions, from
Sure.
Emily Smith to how you ended up where you are and how you structured and financed that along the way, because I think it's a really fascinating chapter.
You want me to speak to capital structure?
Just give a little bit of history through that. You can avoid
in
capital
great
structure.
detail.
I'm going to say less than you did, Doug. That's my goal.
Well, this is just the intro part, so yes.
So I bought a company called Emily Smith Publishers in Nashville, which was really a compliance company serving the HR employment law market. And I bought the company from the founder in 2005. And it was a leveraged deal that where we had senior debt, mezzanine, and seller paper. So there was no outside equity that came into that transaction. Excuse me. And we operated that way for a few years, and I saw the need that we were going to have to make some investments. So I really wanted to do some acquisitions for the business. We were servicing a lot of debt, weren't able to reinvest in the business the way I'd like. And so I brought in a private equity partner in 2007, and we were going to embark on an acquisition strategy, and everybody in this room knows what happens about that time. Credit markets dried up, nobody wanted to go to market, and so we were left in a position where we had to make a decision, and we decided to change our business from being really a print-centric business to digital. And so in 2009, we launched a couple digital products, a subscription portal, and our online training business. And that was a significant, investment for us at that time, and really different than the strategy we had embarked on just, 16 months before that. Fast forward in February of 2011, we had an opportunity to do a merger, which was with BLR. Bob Brady, the founder of BLR, is in the room. We did a cashless merger with Bob, where he rolled his interest with BLR, and my private equity partner and I rolled our interest in Emily Smith and put the two companies together. And before we did the merger, if anybody asked me who's your most direct competitor, it was always BLR. They were in state-specific compliance information in the employment law space. And so we were competing head-to-head with Bob, and it made sense coming through the recession, the impact it had on both of our businesses and what was going on with the economy, to put the two companies together, and that's what we did in February of 11. We operated that way for about a year and a half, and we were able to recap the private equity partners out. Bob's become the majority shareholder today, and we're operating just with pretty reasonable leverage in the business. In November of last year, we were able to acquire HC Pro, which was in the healthcare compliance information business, and so we did that about a year ago this month. And we're able to do that with debt financing, and picked up an asset that we think is in a great market, obviously, with healthcare, what was going on there. But again, did it without bringing outside equity into the business.
And similar to the question I asked Doug about, from a customer standpoint, as they're looking at the products and services that the company provided, let's say 10 years ago, to where it is today, I think that's probably shifted pretty dramatically. And then interestingly, in the compliance market, as you're looking at the sort of M&A decisions of, develop in-house, especially as it comes to software and data or capabilities, versus go out and buy something, just talk a little bit about, the customer transition from their sort of needs in the market, how you've addressed that, and then how you've been thinking about, do we go buy something or do we just figure it out internally?
Sure. I think what we've navigated pretty well is a print to digital transition, and I'd give Bob credit for that. He was early. We have a number of subscription websites. Before the acquisition of HC Pro, we had 80% of our revenue was digital and 80% is recurring, so paid content. And we'd really moved from a newsletter and subscription manual business to one that was largely reliant on subscription websites delivered digitally. And so that was our biggest transition. And when we look at acquisitions, and HC Pro is a good example, we have the ability now to apply what we've learned through that print to digital transition to another business that still is largely a print-centric business. And probably more importantly, or as importantly as moving your content from print to digital, is moving from what was a direct marketing organization to a sales organization. And so today we have a sales organization with more than 50 people. I hired the VP of Sales in December of 2008. And so that transition for us to move away from our roots of really marketing to customers to a sales-driven organization has probably been a more significant transition for us than just moving from print to digital. As I look forward as to where do we want to go next, we really want to get involved in the workflow of our customers. And the reason for that, I think it drives value, is the stickiness of a customer. When you're embedded in their workflow, when they're using your information, data, whatever tools, whatever it might be, when they're using that on a daily basis, the chance that they're going to stay with you is much greater. So I said we went from print to digital. Our renewal rates are in the mid-60s. They were with our print publications. They are today with our digital solutions. It doesn't change. So the information we have has a certain importance and a certain use in their day-to-day activities. What we want to do is get more involved in what these people are doing every day. It goes to Doug's point, really knowing what the customer is spending time on and how you can help them, with their pain points and the issues that they're facing every day. And our belief is if we can do that, that the renewal rates, the retention rates on our customers are going to follow. And the economics, when that happens, are pretty impressive. I haven't found the ability to do that through acquisition. And really, it goes to what Scott was talking about. The valuations are so high. We talk about multiples of EBITDA, and they're talking about multiples of revenue, and I say, we'll pass. So we go back more to a build strategy than a buy strategy.
Yeah. And by the way, if I could just add something what Dan was just saying, integrating yourself into the workflow of your, whether on our side, with the research business, we look at the market research that we're performing as integrating ourselves within, the planning cycles of our marketing clients, right? If we can get into the annual planning cycles of our marketing clients, we think we're embedding ourselves into their workflow on some level. At the same time, the subscription-based research reports that we're developing, here again, the goal is to become so valuable and integrated within the workforce, in the workflow rather, of our readers as well. So,
the thing I'd say about this from our perspective too is that it's a different business to be in software and data. We went from being a print information company to a digital information company, but we were still an information company. But now we're talking about data and software, and I think the investment there is much more significant, and it's a different business. Technology becomes a bigger and bigger part of what you're doing, and really what I'm talking about is development, programmers, and what they're doing. The investment we have to make in that, the lead times it takes to get where you're going are much more significant than in my days of launching a newsletter for $30,000 and seeing if you have a market or not.
And there's a whole cultural evolution that's involved, right? I mean, because in the way that we approached it, I think there are three issues in terms of developing the culture. The first thing you have to do is communicate it clearly, right? You've got to tell people what's important to the organization and where you're going. The next thing you have to do is you have to follow through with a commitment to train, because you probably had to not only tell people about the sales discipline, but you had to invest in that, right? And then the other thing that we found, and this might have been the catalyst that added the most momentum to the cultural transformation of what went on within SourceMedia, is we recruited and changed the DNA of the business. We recruited key executives, we brought them into the business, and they then brought new discipline and new understanding to those disciplines, and they made changes. And I think we've heard that in many of the sessions and both keynotes over the past 2 days as well. The cultural evolution was absolutely key to the success and the transformation of what's going on at SourceMedia.
So I'm going to switch it over to Dan Kortick from the investment side. Dan, you've watched these markets develop for years. Wix actually had backed Doug's original roll-up called Wix Business Information, back starting in 98?
1999.
Yeah, something like that, 99.
Got our own Manoni chapter.
Yeah, the Doug Manoni chapter. But from Wix's standpoint, you sit around the table with your partners, you're looking at, you've been investing in media and information companies and education and other forms of media for a long time. How do you think about the transition, and as you're thinking about making new investments today, what's really interesting and what's kind of scary, and sort of how do you think about making money in an environment that's changing that quickly?
Yeah, I think Dan and Doug covered kind of a lot of the characteristics of these businesses that you're talking about that make these opportunities interesting to us. I'll try and put maybe a finer point or the investor point of view on some of those. I guess first, there's maybe a misconception that private equity really has a shorter-term view than strategic or family-owned businesses might have in their investments, just because of our shorter investment time periods. But Gil, you and I were talking a little bit about this over lunch. The truth is, our investment horizons may be 5 years, 3 to 6 years, 3 to 8 years, whatever it may be to execute on our strategy. But once we get to that point, we actually have to sell these businesses to somebody else who has, a time horizon of, again, at least another 5 years. So when we're making our investments and looking at different businesses, we really are looking out, 10 plus years in order to be able to execute on the strategy that we want to over the shorter period of time. The other perspective that we have with our businesses is really looking at where they are now and looking out through our investment horizon and thinking about, what are we going to do to change these businesses. What we don't want to be doing is selling the same business that we bought. We really do want to bring some real change and add some real value to that business. And that may be through acquisitions, that may be through investing in sales and marketing, it may be investing in technology. whatever it may be, but to make the business look very different than what we bought. But maybe some of the specific characteristics that, that we're looking at, Doug and Dan, really did touch on some of the key words. If we think about, engagement, in the B2B area, and we really do think about it as engagement versus, maybe the traditional or legacy model of exposure, where it was sending out information, hoping, that people are reading it and reacting to it. Whether that's print or digital, right? It's not enough just to distribute information anymore, whether it's in print or digital, and hope people are reading it or clicking on it. It's really about how can you engage with your ecosystem. Doug mentioned the word brand, and I think that's another characteristic that we're really looking at. The brands that each of us have personal and professional investment in. I mean, those are brands that have been built over long periods of time. Our clients, customers, readers, subscribers, trust those brands, and it's really those brands that give us all the permission to do more. We're trusted. American Banker. I mean, people trust the name American Banker. It gives Source the permission to do more, to engage, with that audience. So when we're looking at businesses that we want to invest in, it's definitely businesses that have strong brands, industry segments that are really fragmented on both ends. I think we all kind of sit in the middle of an ecosystem and bringing together buyers and sellers or different constituents, and having a fragmented set of buyers and sellers, increases your importance to each of us. It also provides some acquisition opportunity to make some sense and bring some order to that fragmentation.
Good. Well, thanks. So I want to shift a little bit back to Dan Oswald and talk about just the analysis that you went through when you originally were talking to Bob at BLR, and you were thinking about, do we stay the course on our own? Do we do something transformational from an acquisition standpoint? Just what were the things that you were thinking about that the combination with that business really added value and accelerated in terms of your own just business opportunity?
Yeah, I think we looked at both sides. The cost side obviously is part of that equation, and being able to take cost out of the organization when you put them together. And so we looked at it, and we could make sense of the transaction just from a cost side. But there was more to it than that. And first and foremost, we shared a customer base, but we had different experiences, different strengths, and trying to adopt the best practices from each business was part of our goal in the merger. And so we were looking at, Bob had been early with the websites, had built some really impressive subscription sites with significant revenue. We were earlier in that transition and being able to learn from what they had done and the successes and failures that they had had. We had a stronger events business than what BLR did, and so being able to take that business and leverage it across a larger customer base, in a lot of ways what the merger brought us was the ability to have a larger customer base to sell the existing product set that we had. And that was part of our goal as we brought the two companies together. And so it both made sense from the cost side of the equation. Can we make sense? Does this really, and I think if you ask Bob, he said, we sold it on, we could cut enough costs that it really was meaningful to the organization and value creation to the shareholders. And the upside that we get on the revenue side and the cross-sell ability and taking best practices from each business is just the icing on the cake.
And we'll talk about, so when you talk about engineering it and having a good amount of cost savings, I'm assuming, I can't remember, but at the time you brought in third-party debt to help finance the deal. Is that right or wrong at that time?
We did not, because we did it as a cashless deal, so
okay.
We didn't need to bring any debt. And again, remember, this was 2011. Both companies had been operating through the recession. The economy was tough, and both had seen a downturn both in revenue and profitability. And so by bringing the two businesses together, we were able to kind of fix our balance sheet in a way. Bob came with a business that had absolutely no debt on it. and we emerged from the merger with about 1 turn of debt on the business, which was kind of nice. But really, it was that cost savings that transformed us from that standpoint.
Well, one of the things I think in M&A that you think about as you look at any transaction, you have the internal dynamics, which could be cost savings. So, freeing up capital, getting the sort of greatest hits of the employee bases. You have revenue synergy, so thinking about does 1 + 1 equal more than 2 in terms of putting them together, and are we going to be stronger in the market, and is that going to create value for our company? But then you have this third thing, which is financial engineering, which again ebbs and flows with sort of market conditions. So back in 11, financial engineering or the debt market was really tight, just given the state of the economy, and it was hard to raise third-party financing. And in some cases, like today, just given what's gone on over the last several years, cost of capital is really, really low, and there's a ton of it out there. And so people are using debt financing, to really accelerate their M&A strategies because it's sort of found money at this point in terms of the cost.
And look what it's doing to valuations.
What's that?
And look what it's doing to valuations.
Yeah, and you start seeing that show up in multiples, of course, as people are using other people's money to pay higher prices, which is great for sellers, not so great for buyers. But again, if the cost of capital is relatively low, not a bad place to be. So Doug, as you're going back through your different chapters around M&A, just give us a good example of a situation where you were thinking about organic versus let's just go big or go deep and do a big deal, and talk about how that created value for you guys. And I don't think that question was on here, so that's a nice curveball for you.
That's okay. I like that. So the best example that I could give you is actually a transaction that you're probably somewhat familiar with, and it goes back to the Wix, my days with Wix, where we were very acquisitive. And what we did was we took a very traditional newsletter publishing business that served the private equity marketplace. They had a very well-attended annual conference and some smaller conferences. And we married that business with a progressive database business that also had a research arm to it. In fact, it's funny, but we learn from our successes and our failures, right? And I just spent 5 minutes telling you about the research business that we launched. Well, that was a business that I bought back in 2001 from Reuters, and that's where I got the business model. But at any rate, coming back to what I was just referring to in terms of the merger of what was a newsletter business that served the private equity marketplace along with a conference, married that with a database and research business that served the venture capital industry. And of course, those two markets are very similar. We brought them together under one roof, kind of leveraging the skills of the respective discipline strengths, and it made for a much stronger organization that served related but different markets.
Mm-hmm.
And we also got the cost synergies as well. The way we looked at it was we really wanted the revenue growth. The cost synergy was really the icing on the cake, and it created a tremendous amount of value for Wix and for me in doing that.
Well, good. Well, Dan Kortick at Wix, maybe not using the same example, but think about, out of all the portfolio companies.
That's the one I was going to use.
Oh, yes!
Stole my thunder.
So calling an audible on Dan.
That's okay.
But, you've got hundreds of examples of sort of add-on acquisitions and how you think about those being accretive and why they make sense and why you want to double down on, on a portfolio company.
Yeah. I think what was very unique about the example that Doug gave is, here we are in 2014 talking about the transformation of our businesses from print-centric to data-centric, and here's an example from 2001, where we were talking about the exact same thing.
Mm-hmm.
Obviously, with technology now, it makes a lot of this much more critical, and maybe in financial information, it was something where the market necessitated that we made some of those types of investments earlier. But in all of our companies, we look at again taking that perspective of changing the business, financial engineering, while it can be icing on the cake, it's not where we're going to create any real value for our investors. It really is changing the profile of the businesses, and that can be done both organically and through acquisition. Obviously, because we're a private equity firm and we have access to capital, we tend to be a little bit more biased towards doing acquisitions. We have a sense of urgency about getting things done within our investment time horizon, and when you start doing the buy versus build analysis, given our time frames, it's typically much more efficient for us to be buying versus building, and hoping you get that you're penetrating that addressable market with what you built. It's usually easier just to buy something that you can plug into your existing customer base, your existing platform. We've done it a number of times. We have an existing portfolio company in our most recent fund, North Star Travel, that I think a lot of people may be familiar with. I know there's some people from North Star here. Even right before we bought North Star in 2012, they bought the Focusrite conference in 2011. Focusrite really is, it's a very big research conference for the travel technology industry. Slightly different market than what North Star was serving, in its travel information business. Definitely much more towards, some of the earlier stage, more tech-oriented businesses. Opened up a new market for North Star with that customer base. Really grew their face-to-face revenue stream significantly. And then kind of in our chapter with Focusrite, again in the buy versus build, and now we have this brand, tremendous brand, well known, very well attended conference, grows every year. In fact, it's going on, as we speak. I'll be attending that tomorrow. We can take that brand and now we can extend that brand. We launched a Focusrite Europe this year. It was held in Dublin in March. Cash flow positive, a success by every measure in its first year, and that will only continue to grow. And that's a brand that we can continue to build on.
That's a great example of a transformative acquisition, though, because Tom's a dear friend, and I've got some visibility of the business. We're colleagues in the industry, and I really believe that by getting that deal done, he did change the profile of the business such that the interest in acquiring his business was elevated tenfold. Because of how it changed the revenue diversity and the growth trajectory.
And right? I think I agree with all that, and they did the deal before we bought it, which is part of what made it attractive. So it not only changed the profile of the business, it changed the trajectory of the business, how people internally saw North Star, how outsiders, investors saw North Star. And since then, I think we've done, so we bought the business a little over 2 years ago. I think we've done 5 or 6 additional acquisitions already inside of North Star. We expanded a lot of our existing brands into Asia. We bought some face-to-face events in Singapore. We just relaunched Travel Weekly, which, again, back to very traditional legacy print brand, just launched that in China. Relaunched it in China. So the Focusrite acquisition, which happened the year before we bought the business, really put North Star on a different trajectory. I think people became energized internally and externally, customer base, employees, investors, about building something in a company that hadn't had an acquisition, really hadn't launched a whole lot of new things in a decade.
And you're not afraid of print?
We are not afraid of print. If I look at North Star and the profile of its revenue, our print percentage is definitely declining, but it's not declining because our print is declining. Our print percentage is declining because everything else is growing and growing faster than print. But it comes back to brands. Right? We couldn't do what we're doing in in China without the Travel Weekly print brand. We couldn't do what we're doing with some of the digital data subscription products that we have with travel agents all around the country, all around the world inside of North Star, without Travel Weekly falling on their desk every week and having the respect and the confidence of these travel agents, knowing that the information that we provide is still must-have information. Do I see us expanding our print brands in any material way? Probably not. But we are still investing in some print brands around the world.
So Dan, one of the things you mentioned, which I think might be just worth taking a step back and talking about. So the private equity investor, you had mentioned, 3 to 7 year time horizon. It's just as an observation in terms of how the private equity community, which is increasingly a part of our whole ecosystem, thinks about M&A within a portfolio company. If you think about the investment horizon, sort of behaviors evolve over that. Year 1 and year 2, it's kind of let's go deep and let's try to aggressively acquire because you have 2 or 3 years left in the investment horizon to really make a difference and to really evolve the business. As you get halfway through that investment horizon, it tends to be slow down on the acquisitions unless it's highly accretive, meaning if I can buy something at a 6 times multiple and I know I'm going to sell it at an 8 times, I'll do that all the way till the day before we sell our company. Mm-hmm. But if it's going to be, overpaying or paying an aggressive price, you don't have enough time left in that window to get the return. And so it's just, I point that out only in that as you look at the private equity funds and platforms around the industry, it's something that we pay attention to because it informs sort of behavior in the market.
Yeah, and I'll just respond quickly, and we can move on. But yes, that is a real dynamic. As our partners sit around a table and have that very conversation about real situations with our portfolio companies, we have to make the decision. Are we going to pass on that acquisition because we don't have the time frame left to really extract the value out of it? Or are we going to change our perspective on our time frame and hit the reset button and say, let's go do that?
Yeah, that's a good point.
I think we've made that decision a couple times with business information. Let's hit the reset button and do it because it makes sense.
Yeah, that's a good point.
But don't you run the risk if acquisitions are that big a part of your strategy that you stop a couple of years before your exit thinking that we're not going to get a return? And then we don't exit when we think we are. Then where does that leave you?
Exactly, and that's the difficult conversation. It's we don't do it, and what is the impact on our ultimate returns for our investors when we go to sell the business, or do we hit that reset button and sign up for whatever amount of time that we think we need?
Well, then you fall back to organic growth,
and
right? Which is what we have to.
Yep.
That's our responsibility to tease out of the core businesses.
Yep.